The traditional approach to investing in retirement is inherently flawed. Much has changed over the last decade, but the way in which we construct retirement portfolios and provide advice to retiree clients really hasn't. Welcome back to our 4-part webinar series, Investing in Retirement is Different, where we'll be redefining retirement for the benefit of your business. As you should know now, my name's Tim Dowling. I'm part of the team here at Allianz Retire Plus, and we really do thank you for taking the time to join us here today. I'm very excited to introduce our guest for this session, James Claridge. As CEO and founder of Investfit, James uses his incredible technical expertise as an actuary to help transform the advice industry for the better. He's also spent a number of years building out what can only be described as one of the most powerful tools available to advisors today. And we're going to be spending today's session really exploring what stochastic modelling is and how it can help your business. So James, thanks for taking the time and welcome.
Thank you, Tim. Great to be here.
As I mentioned at the top to James before, we do have a couple of minutes of housekeeping, which I'll just quickly run through. It should all be common knowledge to you now, but as always, we've had some feedback that the audio can be a bit of an issue. So we recommend that if you are having audio problems, opt in to call into your webinar or WebEx system so that you can hear us more clearly. You can do that by clicking the 3 dots at the bottom of your screen, selecting the audio connection button, and then hit call in. It will provide you with a range of call-in numbers, and you can call that number on the screen and enter your access code and attendee ID so that you can hear us. We've obviously got you all on mute and webcams off today as per usual. However, as always, that's not because we don't want to hear from you, quite the opposite actually. We can't wait to hear your thoughts and ideas about the topic today. So what we do ask you to do is contact us via the Q&A button. Again, hitting that button at the bottom of your screen with the 3 dots will bring up a list, and if you select Q&A from that list, you'll be able to ask questions directly to James and myself. We'll endeavour to get to all those questions throughout the presentation, but anything that we don't get to, we'll make sure that we follow up with you afterwards and make sure that you get those answers that you need. Additionally, if you would like to go to the top right-hand corner of your WebEx screen at the moment, you'll also see that you have the option to change your view to what we call floating panel view. And by changing that view, you'll make sure that you won't be cutting the heads off James and I, all the outskirts of today's slides. So potentially a little bit of an easier way to view all the stuff that we'll be talking about today. Lastly, I know that many of you have been tuning into all 4 of our presentations over the last couple of weeks, and we've really loved having you here. We've gotten a lot of questions back about CPD because obviously that's an important factor about these education sessions. So just a reminder that CPD will be issued at the end of all 4 series. Next week is our last episode, and at the end of that, the team here will be tallying up what sessions you attended and making sure that they allocate those CPD points to you. It's the 3rd instalment today, Building and Modelling Retirement Portfolios. And as always, we ask you to come back here, same time, same place, each and every week to understand the entire landscape of retirement and exactly how we feel that we can redefine it for the benefit of your business. We had Jackie Lennon only 2 weeks ago talking about the challenges and the risks that retirees faced. And then we had Veronica Klaus of Lonsec providing you a really robust retirement framework that can allow you to build better retirement portfolios. Next week's session, we're going to be sitting down with 2 advisors, and we're going to be discussing retirement solutions, and in particular, our own solution, FutureSafe, which we're incredibly excited to share with you because we're very confident it's like nothing else you've ever seen before. But today's session is building and modelling retirement portfolios. And as I mentioned at the top, James Claridge is very, very well placed to host this conversation with us because as CEO of Investfit, he's devoted a considerable amount of time to understanding and modelling out retirement portfolios. Maybe I will just duck through this agenda. So obviously today we're going to be touching on a number of topics, but it's going to really form 3 parts or 3 areas: the importance of confidence, the impact of volatility, and our retirement portfolio illustration tool. So the importance of confidence, what do we talk about when we talk about that? Well, James, I'm going to duck to you in a minute just to understand, what the current solutions that are available to people out there today. But firstly, I wanted to share with the audience a little example, a little bet that we did last year at our roadshow. This will be familiar to many of you because, as I know, many of you were there with us when we ran this little experiment. But what this experiment does is it looks at the impact of loss aversion and our need for certainty as investors. So let me explain that a little bit further. What we did was we got attendees to come up onto stage with us, and they were able to choose from one of two options. The first option was a guaranteed $150, and therefore we know from that simple mathematics that the expected return of that outcome is $150. The second option that the client had, or the attendee had, was an 80% chance of winning $200. Now, obviously, given the simple math, we know that 80% times 200 means that the expected return of that option 2 is a fair amount higher at $160 compared to $150. Now, this was a real live bet that we ran for attendees, and we weren't breaching any sort of compliance issues. We were making sure that the money that they did win was devoted to their favourite charity. But what was interesting when we ran this test or this experiment was that 80% of the participants that took part chose the guaranteed $150 compared to the $160. So they had a chance to win more than the $150, but they went with that certainty. And what's interesting about this experiment is that we know loss aversion is a real factor for investors, both in accumulation and decumulation. But it was interesting to see how this loss aversion actually results in people making a real life decision. And speaking with Jackie only 2 weeks ago, we know that loss aversion spikes significantly for retirees, and therefore the options here, or in fact the expected return, the guarantee $150, can be even lower, and they'll still opt for that option because of that certainty, because it guarantees an outcome and they can be comfortable with that outcome. So James, I guess my initial question for you, pardon the long introduction there, is how do we currently account or serve this need for certainty in retirement planning and retirement software?
Sure, thanks, Tim. Yes, at the present point in time, most of the tools that advisors are using are deterministic. And by that, what we mean is they're using the expected values, as you pointed out in that illustration there. So, for example, we might have an assumption around the returns for equities of 7.5%. And when advisors use existing tools, they project that 7.5% year in, year out for the end of time. And with cash and bonds and every other asset class. So what that does is provide an expected value, as you pointed out there. That's the expected outcome. It's a probability weighted outcome. The problem with that is that there's only a 1 in 2 chance of achieving, roughly a 1 in 2 chance of achieving that outcome. So when an advisor shows what is possible for a client's future, using those expected values, that deterministic model, what they're showing really is a 1 in 2 chance of success of achieving that outcome or greater, but also a 1 in 2 chance of failure, as in they will fall short of that outcome.
Right, so inherently an expected return or an expected outcome really shows you that there's a 50% chance that you'll do better than that, but there's also a 50% chance that you'll do worse.
Approximately speaking, that's right. Exactly.
Right.
Yep.
And I guess given, again, that need for certainty and that the impact of loss aversion, what are retiree clients' kind of feedback when they realise that potentially it's a toss of a coin type scenario that they're looking at?
Sure, and naturally, and exactly as your study has shown, is that they are distinctly uncomfortable. So as you approach retirement or in retirement, that's it. What you have is what you have. You're not working anymore, so your sole source of income going forward is what you already have. And if you start drawing down at a rate of income that you've been shown as possible on a deterministic model, not realizing there's a 1 in 2 chance you'll fall short, and then suddenly you're told that, you're pretty uncomfortable. Toss of a coin is not adequate level of confidence for something as important as your retirement income. most people would prefer, if possible, to avoid being on the age pension as their sole source of income too soon. Avoid it altogether if they can, but certainly not too soon. So, yeah, most people are uncomfortable with that. They want something more like 90% confidence rather than 50-50 at that point in their life.
Interesting. And I think it's probably important to point out that what we're talking about here isn't just simple sort of cash flow budgeting type questions, because we can actually get very, very precise with that. And as advisors, we can say, okay, if you want to plan for this cash flow or you want to achieve this goal, we can very easily put money aside for that, and we can, whether it's using the bucketing strategy or an acceptable drawdown method approach, we can get quite certain on being able to, hit a certain goal. But those goals become very, very complex in retirement, right? Because there are a number of variables that are really unknown.
That's correct. Obviously, how long you're going to live, but also, importantly, what the variability in returns are going to be. Other factors, obviously, age pension and how much you're going to draw down and so on. So you're right. So modelling short-term goals is relatively straightforward, and the chance of them going wrong or not achieving those goals is very low. But a retiree at age 65, for example, might still expect to live for another 25 to 30 years. So it's a long time frame with unknown investment returns over that period. So yeah, the next year or two might be quite certain, but beyond that starts to become increasingly uncertain.
And obviously we've seen in the last couple of weeks, and many advisors on the line will know that, we've been exploring this idea of sequencing risk and the significant impact it can have. And so, when things don't go according to plan, or when you are, making assumptions around expected returns, there are these black swan events, there's these fat tails, you need to take into account, that there are things that can happen, and that can have a significant impact on a retiree's lifestyle.
Well, that's correct. And that is the problem with deterministic modelling, is that you are using an expected value. You're modelling that 7.5% or your portfolio return of 6.2% year in, year out. But the reality is it'll be very different. You may well experience a GFC or a coronavirus at some point in the near future or down the track. Portfolios will bounce back, but the timing matters a lot, particularly in retirement when you're purely in drawdown phase rather than accumulation phase. So that's exactly right. So it's really, really important to do that sort of, to account for that variability, those unknown events when you're planning your future.
And Jackie Lennon references it as the floor of averages, but it really just highlights the risk around planning to the average, not for just expected returns, but things like age, things like income, things like what sort of outcome you're going to achieve in retirement.
Exactly, and inflation and other factors that are all variable. We need to account for the variability.
And that's really the key point that we talk about when we talk about the importance of certainty. It comes to the back to that fact that retirees crave certainty. They absolutely need it. Let's explore a little bit about what we can do to that. And what we want to have a look at is the impact of volatility. And so again, as I mentioned, we've spoken about sequencing risk in the past, but let's have a little bit of a look into just how much volatility can impact expected returns. So here what we've got is a simple little drawdown calculation that's showing us a portfolio with a starting balance of $1 million. And we're going to have a look at how the drawdown, or sorry, the actual volatility of returns and the sequence of events can impact that drawdown measure. So we can see here that our first portfolio is measured at the 50th percentile, so it's using those traditional techniques of modelling, and that $1 million at this drawdown rate is lasting until 30 years into retirement. So a pretty acceptable time frame. But as you pointed out at the start, that means that 50% of people are going to have money that lasts beyond that 30 years, and 50% of people are going to have money that falls short of that 30 years. Additionally, we talked about biometric risk a couple of weeks ago, and the fact that the vast majority of advised clients are more wealthier and therefore more healthier than the average. And so even planning to that, anything short of 30 years could be problematic for them as well.
Absolutely, that's right. And in fact, someone age 65 or thereabouts these days might expect for a female to expect to live to age 90, 93 or higher.
Well,
so 30 years is certainly what you'd be looking for, but maybe even longer for people who are retiring younger.
So how does stochastic modelling work? Because I think that this is a phrase that's thrown around a fair bit and potentially may not be understood by everybody, although we may be familiar with the term. So do you want to just explain to us a little bit about stochastic modelling and how that can benefit advisors?
Yeah, certainly, Tim. So stochastic modelling is the next stage or next evolution of modelling from deterministic modelling. So as we said, deterministic modelling, we're just assuming a fixed rate of return into the future, year in, year out. With stochastic modelling, we're actually trying to model the real world because we know that that returns are not even into the future, they're not uniform. So we're trying to reflect that in our modelling. So we model the variability in returns from year to year. We can do it at an asset class level or product level or portfolio level. But the key thing is we're modelling that variability together with the client's future cash flows, savings in, drawdowns, goals, retirement income, and so on. And we're combining all of that and modelling out to the end of life. And with stochastic modelling, you do that many, many times. So we have an engine that determines or that simulates the future thousands of times. And then we can model that client's future thousands of times. And then we can look at what level of confidence we want. So if we want a 90% confidence in the results, we can take the 90th percentile of those results. If we want 50-50, we can take 50-50. But by modeling that variability, we're taking into account the real world, which is that returns do vary. And even for cash, returns vary, but not as much, obviously, as they do for equities, for example. So stochastic modeling is that ability to model the variability in the future, in this case, year by year by year, out to the end of life, and then to incorporate that into the results and enable us to produce a level of confidence in the outcomes that are shown to the client, such as 90% confidence or 75 or 50% confidence. And so what that means is that if we show results at 90% confidence, is literally what it says, the client can be 90% sure that they'll achieve the goals that are shown to them. Or the flip side to that is there's a 10% chance they'll fail, and that's what we call risk. Risk isn't necessarily just the annual volatility in returns that's so commonly talked about, but in the context of a client, for an advisor, risk is the chance that they fail to meet their goals. 90% confidence is the same as 10% risk. And so stochastic modeling does all of that and therefore enables you to have that conversation with the client around confidence or risk.
And it's an interesting point because I know we were talking before this session started about the efficient frontier, and we've done work with Lonsec to update that efficient frontier to better reflect the risks and objectives of retiree clients. But really, again, that efficient frontier is just showing you one measure of risk against one measure of return, and it doesn't show you the full range of possible outcomes. It can help you, move towards what looks like or what seems to be the most efficient portfolio. But given that every individual client's objectives and goals are going to be quite unique in terms of what cash flows they potentially may hope to spend in the future, we need to make sure that we understand the full range of possible outcomes, and we need to incorporate all those goals into quite a sophisticated tool so that we can actually help them understand, okay, there is a 50% chance that you'll achieve this goal, there's a 75% chance, or as you mentioned, retirees would prefer to have that higher level up to, say, 90%.
Spot on. That's right, Tim. And, and you're quite correct. So historically, stochastic modeling has been used, not by advisors so much, but by fund managers who use it to produce an efficient frontier when they determine their portfolios that they recommend. But that is done normally in, as you said, the expected return versus the annual variability or standard deviation of that return. That's not that useful for clients. They don't think in expected returns. 6.2% doesn't mean much to a client. A retirement income of $52,000 with 90% confidence, that means something.
Well, let's go back to our slide here and have a look at that impact of volatility, because as we mentioned, this 50th percentile gets us out to that 30 years. But if we were to really understand the full range of possible outcomes, we'd need to make sure that we'd modelled all these percentiles and so that we can get a full picture. And what's interesting is that as we model both the 75th percentile, the 90th percentile, and even the 95th percentile, there's a big range of outcomes there. So now at the 95th percentile, we're seeing that the assets in the portfolio are running out after 18 years. So it's important to maybe note at this point, this is the same portfolio invested in the same assets in drawing down at the same level throughout this entire individual's life. But the power of stochastic modelling allows us to have a conversation with the client to say, you know, just so you're aware, or just so we understand, there is a 10% chance that your money could run out after 20 years, and there's a 5% chance that it can run out after 18 years. So how does stochastic modelling allow us to change the conversation that we have with our clients?
Well, that's a good point, and that chart is a great illustration of this. So that conversation around risk, you know, historically we've talked about risk in terms of being risk profiled as conservative, moderate, balanced growth, and so on, based on a series of questions. But that again limits is not that useful for a client. What they need to understand is how much money they can draw down in their retirement and how long that will last, and with what level of confidence they have. So we know it's not 100% confidence, and we would never model to 100% confidence because that's not possible. But what is really useful is for a client to say, look, you know, 1 in 2 chance of running short is just not okay. I just don't want to be left in 20 years' time on the age pension. So I need to model and see what I can achieve and what I can draw down in my retirement with a higher level of confidence, so that I'm not pulling out too much money too soon, and that I'm have a high degree of confidence that I can get to that end point in my life at age 90 or 97 or whatever it is. And so that's a better conversation to have. As I said, it's based around what you can achieve in your retirement with what level of confidence you want. And none of us want to be worrying day in, day out whether the pool of money we have at retirement is going to run out in 5 or 10 years' time, and then we'll be on the age pension, and that'll be our sole source of income. If we can avoid that, we will, and we want to do so with a high degree of confidence. So stochastic modelling changes the conversation from we've risk profiled you as a moderate investor based on some questions around annual variability in returns to one around what level of confidence do you want, and how much can you live on at that level of confidence with any given portfolio. And that's what that chart shows so clearly.
Now, obviously, it seems as though, you know, stochastic modelling, in very simple terms, is a better way of modelling. It's allowing us to see a range of outcomes as opposed to understanding just one possible scenario. And it allows us to transform the conversation, as you said, with the retiree client to be more about, you know, what sort of confidence they want to have in retirement and what sort of goals they want to achieve, as opposed to trying to construct a portfolio that you know has the highest expected return on a risk-adjusted basis, using that, you know, traditional measure of standard volatility. So, given that it's so much more powerful, why do advisors not use it, or why haven't we been using it until more recently? That's a
good question, Tim. It's taken us years to build the tool that we've modelled, that built to model stochastically. It's complex. So building that sort of model is complex, and the reality is to do the sort of modelling that we're doing these days just was not feasible on a desktop or a laptop computer previously. Until now, really, the computing power hasn't been there to be able to run these sorts of models in a real-time or near real-time situation that is meaningful for an advisor. So, you know, when I first built Investfit, for example, the prototype I built was in Excel on my laptop, using VBA, which is a language inside Excel. And to do what our current version does would have taken about a day. So that's just too long to be a practical solution. So firstly, it wasn't generally available anyway. No one had written an application that did stochastic modelling for the individual. It was all that portfolio modelling that fund managers do, for example. And secondly, the computing power really wasn't there in an accessible form, you know, readily accessible form, to be able to produce the sort of analytics that we do now using stochastic modelling. So it just really hasn't been plausible at a practical level to do it until fairly recently, and it's taken us a long time to build that, even, you know, over the last 5 years.
Yeah, I love that story about, you know, you've built this amazing model in Excel. It does, an incredible amount of work in terms of being able to deliver a great outcome. But for the advisor sitting there with a client, it's not really practical for them to be running a model that's going to take a day or two to come up with the right answer.
Exactly. So, and that's exactly right. When we first built it, we thought, wow, this is actually useful. This is a really powerful tool. The outcomes from this tool are really, can really change the quality of advice and indeed outcomes for advisors and their clients. But it's not going to work if it takes that long to run.
And we're going to be asking people on the line today to share with us if they feel as though stochastic modelling is something that they can use in their business. But in the meantime, we'd love to hear any questions or queries you have for James in terms of how you can bring stochastic modelling to your business, or even if you'd like to share with us any experiences that you've had. But I guess the important key point to really take away there from us when we talk about the impact of volatility is about understanding that full range of outcomes. Not just modelling to the 50th percent.
That's it. That is a key takeout.
Well, look, what we're going to do now is actually dive into our portfolio, retirement portfolio illustration tool. And this is a tool that's available for advisors today. Now, the engine sitting behind this is all James's hard work over the last 6 or 7 years.
That's right.
And we're incredibly proud and excited to be partnering with Investfit to deliver this tool to advisors today. The power of the tool, and really to James's point about the fact that this is sort of the technology that's been reserved for institutional investors only up until more recently, just from a practicality sense. But now we're going to step through this tool in live, and we're going to show advisors and everyone on the line just exactly, first of all, what the tool's doing, but also the speed at which it does it, because I think it's just really quite incredible. Great. So let's just step through this. So Investfit is not only combining the power of stochastic modelling, but it's also, James and the team have done an incredible job of taking into account what the needs of the clients and the advisors are. And obviously one of those needs is to ensure that the system is very, very user-friendly and very easy to use. So what you'll see here is that the first question you're requested to answer is if you're generating this for a single or a couple. We'll make sure that we just hit the single to make this as easy as possible. We'll make sure that we enter a customer ID, and James, I'm going to put your details in here. We also get asked if the client owns their own home. What's the reason behind the home question?
The home question is, well, Investfit allows the option for the advisor and the client to use some of the home equity to fund their retirement, should they wish to do so. That's one lever you can pull in your retirement, obviously, is to access your home equity to fund your retirement income through a reverse mortgage or a downsizing.
Okay, interesting. So obviously a lot of functionality there to explore different retirement strategy solutions.
That's correct. Yeah, exactly, Tim.
Again, we're just going to put James's name in here, but this is where you'd enter the name of the client. You can select the current age, which we'll select as 65, which means that the client is obviously retired. And hitting next, we get the option to put in the current balance of the superannuation, as well as what that superannuation is invested in. So what's the point around this initial question about how the current portfolio is invested? Why is that important?
Good question, Tim. So one of the things we're going to show in the results is how the optimal or the comparative portfolio compares to your current situation.
Right.
So we're just trying to contrast where you are now with where you could be if you change that investment portfolio. So it's really just showing how you can improve your outcomes by changing.
Okay, and we're going to touch on that again in a second, because I want to point out a really interesting aspect to Investfit as a tool, because it's not just the stochastic modelling that's going on there. There's a second, even more powerful, potentially, calculation that's going on. So we'll talk about that in a minute. But for this simple example, we're going to say that the client has $1 million in the home with no debt.
Yep.
And we're also going to say that they have $1 million in super with no debt. And we're going to say that we don't know how that superannuation is invested. But what we will use is one of the pre-populated model portfolios here, and we're going to assume that the client is a moderate investor. Again, very similar to what we see asset allocation being, given that those retiree clients are usually risk averse?
Risk averse, exactly.
Now, for those of you who were with us last week, you know what the results are going to show here, because we know that those more conservative portfolios do not offer the optimal allocation for retiree clients. And in fact, a growth portfolio can significantly reduce the probability of running out of money. And that was really one of the key goals of modelling the Investfit tool, was that probability of running out of money and understanding the range of outcomes and being able to kind of offer that confidence, right?
That's correct, Tim. That is exactly one of the key goals, and this hopefully shows it very clearly.
So we'll hit next, and again, we'll just, for simplicity reasons, we'll say that there is no other investments outside of superannuation. But again, James, the power of the tool is that it can model those assets outside of superannuation and take those into account as well. So it really takes a total portfolio view of the individual's wealth.
Correct, and we think that's, if you have that information, that is the most meaningful set of results, is if you model holistically. We think that is the best way to provide advice.
And here it is, hold tight. So what's happening at this stage? Because it doesn't take a day anymore, but it does still take about 30 or 40 seconds. So do you want to just discuss exactly what's going on while we wait for this to load?
Sure, Tim. Yeah, it does take a little bit of time, but enough to use with a client present, short enough to use with the client present. Yes, what that's doing is it's sending all that data, the client data, through to our engine, and it's doing the stochastic modeling. That is, it's simulating the future thousands of times, and it's doing that for each of the portfolios being modeled. So if we're modeling 400 portfolios and we're doing 1,000 simulations, for example, it's 400,000 simulations of the future. And there's, each one of those contains many, many calculations. So it's doing billions of calculations in that time frame to show the different results at a given level of confidence for a wide range of portfolios.
Interesting. So again, a really differentiating factor for the tool, and I think an important point to make, is that a lot of stochastic modelling is often just done on that one individual portfolio. So you go out there, you decide the portfolio as an advisor that's best for your client, and then as sort of a risk mitigation type approach, you go in there and you do some stochastic modelling to say, okay, well, if the GFC happened again, we have a conditional value at risk measure of $20,000, and that's what we expect to lose, or 2.3% of the portfolio's value. So it can be used as a risk metric and understanding of risk tool, but what you guys have done here is actually develop it further into a product that can not only understand those measures of risk in terms of what's the probability of achieving my goals, but also what's the optimal asset allocation needed to achieve those goals, which I think is very, very powerful.
That's right, Tim, and that's a key part of what Investfit does. It's an optimization tool overlaid on a stochastic modeling tool. So we can compare a wide range of portfolios at the same level of confidence. And that's critical, and we think that also helps with best interest duty for advisors, because they can actually say to their client, look, we've just evaluated 400 different portfolios with your particular financial circumstances and goals taken into account, and at the level of confidence that you've chosen to see the results.
That's a powerful sentence. Maybe we can get that in some SOA text for the advisors, because that's a very powerful sentence to have. Yeah. We're getting some Q&As through, but I just want to scroll down to a graph before we do answer those, because I know that this graph is going to, again, just highlight exactly what the tool is doing before we jump to some of those questions. So we've got this scatter plot here. There's a lot of grey dots. There's a red dot and a blue dot. James, what's going on here?
Right. So for each of the dots on that scatter plot represents a portfolio or an asset allocation or an investment strategy, whatever is being modeled. So each one of those dots is a portfolio.
Right. And as I hover over, I can actually see.
That's right. The allocation.
Underlying. Yep.
That's right. So each one of those dots is a portfolio, and we've modeled that each portfolio, as I said, 1,000 or more times, and come up with the retirement income that the client could afford for that portfolio at the chosen level of confidence. In this case, the default is 90%.
Right.
The advisor and the client can change that to other levels of confidence as they choose right now, but given the first run. So the retirement income shown on the vertical axis there is, in today's values, what that client could afford, with 90% confidence their money would last until age 90 in this case, and they can change that too. But that based on the current settings. So they're all equally likely outcomes. They're properly risk adjusted. They're equally risk portfolios.
Right.
there's a 90% chance that the client would achieve the retirement income shown, or put the other way, as I said earlier, a 10% risk they'll fall short. This to us is the proper meaning of risk, the chance that you fail to meet your goals. It's not the annual variability returns, it's the chance that you fail to meet your goals. So these are all equally risky. We're comparing oranges to oranges here. And so you can see the blue dot is where the client could be, the red dot is where they currently are, and the grey dots are all the other portfolios that we modelled. So clearly you want to maximise your the horizontal axis is some measure of that short-term variability in returns.
Right.
That's the bumpiness of the journey. It's how much volatility you're going to experience. And that's an important factor for people.
So what we're seeing here is this red portfolio, which is our current asset allocation that we inputted at the start when we said that the client was in a moderate
portfolio,
right? The graph is showing us a couple of interesting things here. It's saying that there's alternate asset allocations that I could select as an advisor that would actually reduce my short-term risk and not reduce the level of income that I could afford. So firstly, there's a conversation that we can have there saying, hey, if you're comfortable with the retirement income you're receiving, let's make the journey a little bit more enjoyable for you. Exactly right.
And that's really powerful. As we said earlier, people, and particularly retirees, crave that level of certainty and and fear that volatility that they experience in their portfolio return. So why not reduce that fear, reduce that uncertainty by moving to a portfolio, as you say, same level of retirement income, 90% chance you'll achieve that, but let's have a less bumpy journey, a less uncomfortable journey on the way through.
And for those advisors who want to add even more value, there is what we call the optimal portfolio or the comparison portfolio up here. And this is showing an asset allocation that can actually, in this case, afford $2,000 extra a year, or over the 30 years of retirement, about $60,000 extra in income. But again, for the same level of risk in terms of the probability of being able to achieve those outcomes, those goals.
Exactly right, Tim. So that's $60,000 in today's values. So that's a significant amount simply by changing their investment strategy, but with the same level of risk, precisely. So still only 90% chance that they will fail to meet the goal, that they'll achieve their goals, or 10% chance that they won't get there. So again, if you can withstand the slightly higher level of volatility the way through, with the confidence knowing that you're still going to get there just as much as the red portfolio, but with a higher level of income, then that could be the portfolio for you.
We've got a question that's come through here. Will it be able to take into account defined benefit pensions?
Okay, so at this stage, unfortunately have to say no. We have not modelled defined benefit. That is on our development backlog, and we will be modelling defined benefit into the future. Obviously, there are still some defined benefit schemes around, and so we will take them into account. But for the moment, it's only modelling and accumulation and pension based.
Okay, so great question, Rebecca. Thanks for that.
Yeah.
But obviously, that DB account, that DB modelling is coming. Another question from John. Does it take into account any age pension entitlements when asset levels are reduced? Well, it's probably a good time to scroll up to this graph here and explain perhaps what's coming, what's been shown in this individual retirement income breakdown.
That's right. So that's just a simple display of how that the retirement income that's been shown for this client for the optimal portfolio or the comparison portfolio. That's just showing its breakdown into investment income, capital drawdown in green, investment income in blue, and the age pension in red. And so, yes, it has an age pension calculator in it. So it's based on the income and assets test, and that kicks in whenever they're entitled to it. You can actually turn that off. So if you want to model without the age pension, there's a toggle feature. You can sit in the settings page and turn it off and rerun it without the age pension if you just want to show the client what it looks like without.
Thanks for the question, John. And so it looks as though obviously age pension is taken into account as the client's assets fall. But again, this is done at that 90th percentile of confidence. So there could be scenarios where, in fact, there is no need for age pension depending on how long those assets last.
Totally. As we know, if we use a deterministic model, you would show a retirement age pension being accessible much later in the piece because we're assuming a higher level of return effectively.
Adrian's asked, is the blue portfolio asset allocation based on product selection? So this is an interesting question, which I might just dive into ahead of you there. As I mentioned, we call this tool the retirement portfolio illustration tool. It's powered by Investfit, and obviously we leverage all their capabilities as a firm. The difference between this tool and the full version of Investfit is that each one of these grey portfolios incorporates a 30% allocation to our innovative retirement product, FutureSafe. So you'll see here that this blue portfolio has a 30% allocation to FutureSafe with a 0% floor. Now, we'll be diving into a little bit more detail next week in terms of the actual product FutureSafe and how it will work for your clients and how you can gain benefit from it. But if you'd like to, we'll make sure that everyone who's in attendance today will get access to this retirement portfolio illustration tool. Obviously, if you'd like full access to the Investfit tool, James, they can reach out to you guys directly.
That's right. Yes, that could be configured for their own particular needs.
We're going to go through and have a little look at some of the levers that you mentioned there, because this tool's a little bit different to, say, other tools that have been created in the past that ask for your retirement income up front and then tell you what's the probability of you being able to achieve that. You guys didn't go down that path. Do you want to explain perhaps why that's the case?
Yeah, so, in the original prototype version, you could do that. But what we found was that the retirement income is really the most important thing for retirees. It's what they can actually live on. And so the way we've constructed Investfit is you can select your other goals and it'll tell you what retirement income is possible at your chosen level of confidence. And then what that does, it ensures that we don't end up with some accidentally silly outcomes. For example, if someone said, I want to live on $200,000 a year, and they've already got a portfolio of $500,000, that's not going to be a viable outcome.
Right.
So what we do is allow you to set the other goals you want. So there could be some non-income-based goals or one-off goals, or your legacy for your kids, and so on and so forth. And then we find, given the level of confidence you've chosen, what retirement income you could afford at that level. And then, if that's not enough, there's other levers you can pull. As you can see in the tabs there, you can change your retirement age. You could, if you're already retired, then you could change your target age for when your funds run out. You could access your home equity. You could you can change the confidence level. You can change the level of short-term volatility you're prepared to accept, that bumpiness of the journey.
Right.
So there's a bunch of other levers you can pull to then get that retirement income to the level that you're happy with, at the level of confidence that you're happy with, and the level of short-term volatility you can tolerate.
So it actually really transforms, again, for the benefit of the advisor and their client, the conversation that's happening, because now we can say, look, we have this goal of providing a legacy of $200,000, or we had a number in our head of $50,000 of retirement income, and we can actually see the impact of changing those things and what it has on the actual advice and the actual recommendations to the client. We can say, okay, well, look, we know that you wanted $200,000, but understand that that means $1,000 less in annual income for you as a retired client. If you'd like to drop that from 200,000 to 150, here's the impact on income. Does that look like a more attainable or satisfactory goal for you? And it's less about what's exactly the income that they are trying to get to, and it's more about how can we understand these trade-offs in these goals and objectives, with obviously that excellent piece of certainty thrown in there, because it's really about understanding, well, what's the probability of achieving those? Spot on, Tim.
That's exactly right. Life is all about trade-offs. And so this tool hopefully demonstrates to the client what those trade-offs are, exactly as you said, but all at a given level of confidence. So that's the power of it. Everything's on a like-for-like basis, and you can set the level of confidence, and you can pull those other levers, change the legacy you leave for kids, and see how that impacts your retirement income, or whether you access your home equity, what impact it has. So that is part of the power of the tool.
So the retirement portfolio illustration tool, when we talk about that, the real key thing that we're trying to get across is that this is an advice, client-centric tool that's ready and available for you today. So we've obviously looked at the importance of certainty and the fact that retirees crave certainty, the impact of volatility and the importance of understanding that full range of possible outcomes. And we've also looked at the Investfit tool and the retirement portfolio illustration tool that can allow you to give that high level of certainty and really transform the conversations you can have with your retiree clients. My goal for you now is to leave this webinar and strongly consider utilising Investfit and stochastic modelling more generally as the most powerful way to provide advice to your retiree clients. James, we're just about on time there. Thanks so much for coming in. Thanks for taking the time. And as I mentioned, if people have specific questions about Investfit, they can obviously reach out to you. But as I mentioned, all the attendees today will have the option to register for our tool. There'll be a quick survey after the webinar when you jump off. So make sure that you select yes in that survey, and we'll reach out and make sure you have access to what is a fantastic tool you've built here, James. So fantastic work. Thank you very much and congratulations.
Great. Thank you, Tim. And thanks for everyone for joining us today.
I better just throw up this quick disclaimer before I get in trouble. Thanks again, guys, and we'll see you again same time, same place next week.